Welcome back. Calgro M3 has reported higher profits for the first half. This as the group benefited from a positive product mix and lower infrastructure costs. But the group saw pressure on its revenue. Group CEO Wikus Lategan says the company remains poised for a transformative growth phase. He joins us now with more detail on that performance. Thank you so much for your time, Wikus. Let's actually start off there with that top line. What was responsible for a softening there?
Yeah, so sales are definitely under pressure, but maybe before I go into what's responsible for the top line, if I may just add to it, it's very difficult to look at the top line without also looking at the contribution from the joint ventures.
Okay.
So you'll see the top line dropped from 688 million to 507 million, but the revenue in the joint ventures, which is the Southwills project, ultimately our joint venture partner being Standard Bank, and they had a funding partner, we the development partner, so it's actually all the revenue there. This grew from 23 million to 175 million. So if you add all those numbers, you're actually in the real terms only down about 28 million in terms of revenue, or 3.8%. So I think that's a starting ground for that discussion.
Okay.
But sales are definitely under pressure. You'll see that we said 869 units, all to the open market. That means all sales to the man on the street. But that's a tough market. Even at our average sales price of 636,000 Rand, the consumer's under severe financial pressure. And the interest rate environment, where we've seen a relaxation of 25 basis points, that's on a 600,000 Rand home loan. It's only 250 Rand a month. So that severely impacted the sales. Once we get to a combined 100 basis points, which hopefully we'll see 25 basis points still this year,
yes,
and hopefully earlier next year another 50 basis points, then that's 920 Rand difference in your bond installments. Then we believe we'll start seeing the uptick. To counter that, at the end of November, we're launching our first two-bedroom units, again, redesign for 499,000 Rand and a one-bedroom for 399,000 Rand. Really capturing this lower LSM groups. For so long, all of us as developers have said there's a big housing backlog, but with reality, we haven't been able to capture it.
Well,
and that's how we believe.
Wikus, do you think then that you could have reached the bottom of that pressure in that residential property development segment?
Yes, I'm always scared to say we've reached the bottom. Every time I said it in the past, something surprised me. But yes, I think we'd reached the bottom of the high interest rate environment. We're already down 25 basis points. If you look at economists throughout the country, they're expecting at least a 25 basis points. I said to someone this morning, I want to put my heart on it and say, let's hope for a 50 basis point reduction. Yes. But I think we reached the bottom out in this cycle, and now we can all look forward. And what one have to remember with housing is not a luxury, it's a necessity. Go and stand in the corner of Diepsloot, Honeydew, Khayelitsha and Cape Town, and look how many people are leaving for formal job opportunity at 4:45 a.m. in the morning to get on a taxi, travel an hour and a half, 2 hours to work. Those people don't deserve to stay in those conditions, and that's the people we're trying to service in the lower end of the market.
Right. Well, with all these dynamics on the top line, what level of satisfaction are your profit margins sitting at for you?
Yeah, so the GP is starting to pick up. You'll see it's above our target range of 20 to 25%. Our development business is sitting on 27%. Our Memorial Parks business on 57%. You'll see our Memorial Park business grew substantially during the period, just showing that that business's resilience for economic cycles because it's such a cultural business, and starting to play the role as a real risk mitigator, which also for the first time has covered our group administrative expenses. But if you look at the 27%, so back to the development business, one can easily say, but aren't your margin too high? Now, where that actually comes from is the group is starting to benefit from historic land costs. Remember, we don't revalue our assets, so there's no revaluation going through. Infrastructure over many years been installed. So if someone have to buy land today, they pay X. We bought land 10 years ago, so it's X divided by 2, if not less. And that's starting to come through the margin. Then our efficiencies in building less construction area for sellable area, that's starting to come through. And then you might remember that last time we spoke, I said, they were actually giving some of that margin back to the consumer, keeping the sales prices stable. And you'll see our sales prices have only increased by 4% year on year for the last 2 years. Again, trying to help the consumer afford their own homes.
You spoke a bit about your pipeline there, but on the other side of the coin, I'm just wondering on the projects that you are divesting from, what criteria are they not meeting?
So it's a big capital checks. So if you look at the projects we want to take forward, so there's actually three categories.
Yeah.
The first one is we're divesting from some projects. That's where the bulk and link infrastructure check, in our case, for capital allocation is just too big in terms of potential returns. It doesn't say there's not good returns, but in our case, it's too big.
Okay.
Then there's three projects specifically. I'm going to touch on Jabulani and Scottsdene, where we're going to trade them out over the next 24 to 30 months. So they're close to an end. And then you're looking at the projects we want to continue. So Bella, Frederick and Cape Town, Fleurhof, Southwest and Bankenveld, our new big development. And you'll see we specifically touch on Bankenveld to say, if you look at Fleurhof and Bella, we completed the infrastructure, very near completed, so that we now can focus all our financial capital, as also human capital, on Bankenveld, that we don't have this pressure on capital allocation between these projects. And that's a criteria we're just trying to meet. So it's balancing that shareholder value return versus what we can do for the consumer and where we can sell and where capital is best used.
Yeah. Well, talking about the best use of the business, your bottom line did grow by 29%. What are you focusing on that will determine the growth momentum in the short to medium term?
So lower LSM sales on our development business, just continue on the growth trajectory for our Moral Park business. Administrative expenses, you'll see, is down a further 2%. You might remember it was down 4.6% for the previous full year. And just out of interest, our administrative expenses for the 6 months ending August 2015 was 55 million. Administrative expenses for August 2024, 10 years later, is 49 million. That's a saving of 10.9%. 10 years later in rand terms. Yeah. And that's just showing that we're really turning over that sense, focusing on efficiencies, focusing to see where we can save money and really try and target this lower end of the market, because ultimately the lower you're on the market, the broader that pyramid is, just because affordability plays a big role in a country where housing is such a necessity. But labor rates are also fairly low in terms of world comparisons.
Yeah. And just lastly, Wikus, as we end off the conversation, adding value to shareholder pockets, what can investors look forward to in the short to medium term?
Yeah, so I think there's a few things from a capital allocation perspective. Already said trading out 2-3 of the projects over the next 24 to 30 months. Then the disinvestment or sale of 3 of the projects specifically, that capital will go into the capital allocation pot. And then driving Bankenveld, we should be in the ground. That's if not the promise, one of the promise properties in Africa, bring affordable housing to the richest mile between Waterfall and Sandton. So even if Waterfall develops more and more as a business hub, like it's currently doing, we're still on the doorstep of affordable housing for that. We hope to be in the ground in the first quarter of next year for bulk and link infrastructure, in the ground the first quarter of 2026 for top structures, and a handover of the first units, if not December 2026, February 2027. So the first cash upside from that. But running that alongside Southhills, Fleurhof, Bella specifically, so that you always have this risk mitigation. You're not focusing on one project only. And then on Moral Parks business, Bloemfontein, burial rights in place, going well, developments completed, continued development of Platinum City in Rustenburg, and once that's up and running, the rollout throughout the country, so that we can just make a bigger impact also in dignified burials. So I think a lot of scope at this stage.
And more share buybacks?
Very definitely part of the capital allocation. Is not mutually exclusive. We look at divesting from projects, then investment in current projects. And alongside investment in current projects, allocation between our human capital, so what capacity do we have, where to focus, share buybacks and dividend policy we announced earlier this year, so also cash return to shareholders on an annual basis. And it all is just nothing is mutually exclusive of them.
All right. Well, thank you so much for your time and for your insights there, Wikus. Much appreciated. That was Wikus Lategan, CEO for Calgro M3.